All right, so let's begin the show. World Entrepreneurs Day is a global celebration of entrepreneurship and the people who drive innovation, create jobs and contribute to economic growth. Now, India is now the hub of startup ecosystem in the world, ranking third with over 90,000 startups and 107 unicorn companies worth $30 billion after the United States and China. The central government, under the leadership of Prime Minister Narendra Modi, has also begun and promoted the Startup India initiative to help aspiring entrepreneurs. It's that day which acknowledges the critical role that entrepreneurs play in shaping the business landscape and improving society. So let's discuss all of this and let's understand if India can be the mecca of startup. I have with me Sameer Mehta, co-founder and CEO, Port. Sameer, good evening and welcome to the show. And congratulations and wish you a very happy entrepreneurs or a startup day. But then let's begin with a message that you have to give to all the budding entrepreneurs watching this show, listening to you right now.
Thanks for inviting me on the show. I think it's a pleasure to talk to you. I think, the World Entrepreneurship Day or, maybe a startup day, whatever you want to call it, right? I think India is doing exceedingly well, right? You look at the number of unicorns coming out of India. I mean, the journey has been fabulous over the last 7, 8 years. And I believe the next 10 years are India's years, right? I mean, we have the brain power to deliver it and, the market size also along with it to kind of have a genuinely vibrant local ecosystem. I think my advice to budding entrepreneurs would be essentially to focus on vision, right? If you have the vision, if you know what you're building, I think that's a very, very key thing to know before you start, whatever you want to do, right? It could be a SaaS play, it could be a D2C e-commerce play, it could be an FMCG play, but just having that vision is very important. Along with the vision, I would say that, perseverance and being a little more detail oriented is super, super critical because you're building for scale, right? You're not trying to build a small business, which is, 20, 50, 100 crores. You're trying to create, big companies, right? Legacy companies. And for that, you essentially need to make sure that, you're detail oriented and at the same time, not a micromanager. Along with that, just get that vision out there and see what you want to build. So I mean that's my two bits to any upcoming entrepreneur who's looking to make it big.
All right, Sameer. So the message and focus for entrepreneurs. But then, having said that, Sameer, you've come a long way, and so has India when it comes to the startup culture and the entire ecosystem is concerned. Where they've got support, we are getting support from the center as well as the state-supported initiatives and reforms. What, according to you, still actually remains a challenge, considering the kind of market conditions we have in India and globally?
To be very honest, I think the government has been doing a fabulous job in promoting the startup ecosystem. I think back in the day when we started Boat, I think, this ecosystem was missing and, we had to kind of work a little more harder back then to get, people to recognize what we were doing. The funding was hard to come along, and especially in the industry we are in, people don't believe the story, but, that's something that we managed to change. I think India, in the short term, there are a couple of challenges, which is around the funding winter that's happening right now, and the focus on profitability. These are the two things that are short-term challenges for any upcoming entrepreneur. But in the long run, right, I don't see any challenges for India and the Indian ecosystem because essentially we are, the largest TAM in the world is based in India, right? We are 1.44 billion people. We are not dependent on other economies to, our economy is not dependent on other economies. So I feel that, over a longer period of time, I don't see a lot of challenges for Indian ecosystem. I think we will grow from here and probably become the world's largest, startup ecosystem in the world over a period of time.
Now, despite all of this, Sameer, what do you have to say about the funding winter that's going on? Do you see the entire ecosystem or this culture reviving coming out of this funding winter scenario?
I think it's changing. It's already changing, right? There was a time when there was so much access to easy money available in the United States, and all of that money was flowing into startups. Now, VC or PEs are also being a little more prudent in terms of where they're putting money. Valuations are not going crazy, which are doubling up every month, right? People have understood, profitability is a key metric, which we've always followed. We've ensured that, we've stayed profitable. And, that's been our journey. And we are very clear about how we wanted to build this company. Essentially, I think, things are changing now. People have started to recognize good companies and they've started putting money behind it. Having access to the kind of money that was available in the past few years, that may not come back anytime soon, but there is money available if the companies are right, if the founders are amazing, and the business model makes sense. There is still money available in the system to be put into any company.
Sameer, let's talk about your story. Now, you and Aman have really come a long way with your own story in building up your brand. You've also mentored a lot of entrepreneurs. Now, talking about specifically women entrepreneurs, what's the trajectory been like in last few years? What's their growth story? When you go out and mentor women entrepreneurs, what's the kind of response that you're seeing?
Yeah, honestly, I think women are smarter than men. They're more hardworking than men. So, it's obviously right that, they start, they've all started to, contribute to this whole, we're recognizing women as, entrepreneurs as well. And there are such great examples, right? There's Vinita from Sugar, or Priyanka from the sleep company. Women are actually essentially, much, much more smarter, much more stronger over a period of time. I think it's just that now they're finding their foothold in the ecosystem and building it, and it'll continue, right? The momentum will definitely continue. I think the parity between genders, right? I think it is not relevant when you're building a business. I think people tend to kind of take it very lightly, between two genders. But honestly, I think when you're out there and building something, I think the kind of hard work and the dedication required is equal. And like I said, women are more smarter, so they can get there faster than men.
So, similarly, Sameer, talking about ideas and concepts, what according to you is so unique, in terms of ideas and concepts that's putting India on the global map?
So, I mean, there are so many successful stories coming out of India, right? India was never known as a software product company, but now you look at Freshworks, or if you look at Zoho, they've done it, right? They've gone out and created credible businesses which are multinational plays. Along the way, we feel that a lot of Indian product companies will also go out and do that, right? These can be hardware products where companies like ours at Board, or companies like Sugar, or there are so many more that I can't even name here, right? Most of them are creating such amazingly credible businesses. Look at PhonePe, what they've done, right? They came out of Flipkart, and they've now the largest payment aggregators in India. I think it's India's next 10 years. India is going to be shining, and India is going to be very, very vibrant when it comes to this whole ecosystem, and will create truly world-class companies out of India over the next 10 years.
All right, last question to you, Sameer. Now, since you are on the Money Show, we would like you to wear the mentor hat and give some mentoring tips to our viewers. What should they focus on, and what would be your guidance to them?
I think happy entrepreneurship day, and keep working hard, be detail oriented, and plan better. I think that's what we need to do, and the world is yours, and you can paint the sky blue.
All right, Sameer, that will be all. Thank you so much for being on the show today, and a very important day, and sharing all the nitty-gritties, and in fact, playing that great role of being a great mentor to our viewers. Thank you so much. We move on, and let's slip into a short break. Post that, we'll talk about a fund which should be in your portfolio, a US-based fund of fund. How exactly should you be looking at international diversification at this point in time? All of this and more in Meet Your Fund Manager after this break. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Now, for you to get the right fund for your portfolio, it's imperative for you to know the fund manager and their strategies, which is why we get you Meet Your Fund Manager segment. And the fund in focus today is Edelweiss US Technology Equity Fund of Fund. And to discuss more on this, I have with me Niranjan Awasthi, SVP and Head of Product Marketing and Digital, Edelweiss Mutual Fund. Niranjan, good evening and welcome to the show. And let's focus on the US market first. We'll talk about the tech space and tech stocks later on and more in detail about the fund. But then let's talk about how well is a US market placed considering all the concerning factors.
Hi, Kavita. Thanks for having me. So broadly, if you see US market over the last 1 year was grappling with, high inflation, and due to which we have seen US Fed increasing rates at a, more than precedent rate till almost more than 5%. And this broadly, you can say successfully managed to bring down inflation. So as we speak today, of course, the economic growth of the US economy has been subdued over the past couple of quarters and is expected to remain so given inflation is still very high, well above the Fed's target. And there is no stimulus to the economy because Fed is on a rate rising spree. However, in pockets, whether we talk about unemployment numbers, which are very low, overall consumer spending has been gradually improving over the past one and a half year. The housing market is quite stable now. So in pockets, I think so things are looking better. However, overall, if you see, the economy is still slow and much below, or I would say firing much below its expected.
All right, now talking about specifically having exposure in the US market, diversification is always a great strategy, but then for one to diversify towards international market, you need to make sure that your core portfolio is sorted and you are an investor who's ready for an international diversification. Talking about diversification towards specifically US market, you think that is something that one must consider if at all you're looking at international markets, or along with this, you can also club it with different economies?
So US is the world's largest economy, and if you are investing in equity, you can't ignore a market which has more than 40-50% weight to the overall market cap in the world. But the expectation while such diversification has to be right and correct. Over long run, we all know India would do well. Returns will be made in India as well because it's growing much faster than many other developed economies. But when it comes to diversification, if you're looking beyond India, one cannot ignore US. US is a superpower, a largest market. Specifically, there are businesses or sectors which are not present at that scale in any other country apart from US. If you talk about technology, if we talk about many other innovative healthcare businesses which are there in US, so many of these businesses, if you want to buy, you have to go to US market as a part of your diversification strategy.
All right, talking about your US technology fund, it's basically a fund of funds. So let's break this down, Niranjan, and let's first talk about what exactly is a fund of fund.
So fund of fund is simply a fund which in turn invest in an underlying fund. So when we talk about Edelweiss US Technology Fund, it's a fund of fund which invests into an underlying fund, that is JP Morgan US Technology Fund, which essentially invests in technology companies in US or companies which are listed in US markets.
So, Niranjan, talking specifically about the tech space right now, this is one space in the US market that's always very buzzing, and, investors who are already investing and who are also looking at the US market are usually bullish when it comes to the tech space, okay? And not to forget, this tech space really gives you a lot of triggers and cues for the rest of the world markets also, the way they might just behave in a particular day or in a season. But how exciting this particular tech space is for you and for this particular fund? What's the kind of exposure we are talking about? What are the technicals in terms of exposures, if you could also elaborate on that?
Sure. So talking about technology as a theme, is one of the most dynamic themes over the last couple of decades. We have seen technology changing hands right from industrialization to electricity, electrification of economies, to internet, to now we all talking about AI, which is generative AI. So in each decade, every decade there is a change in phase of technology, and this fund essentially tries to capture these change, the mega trends within the technology sectors, and try to create a portfolio and that generate commensurate returns in this specific theme. So US, when we talk about US is a giant when it comes to technology. If you look at the overall technology index of MSCI Tech Index across the world, 80%, more than 85% exposure comes from US tech stock. So they are huge, they are giants, and they are not only into one specific field, but they are all over. So when we talk about maybe AI, it's a US company. When we talk about internet giants, it's it's US companies, e-commerce, digital, be it digital streaming, be it electrification of cars, semiconductors. Most of these companies in each of these sectors, large companies, are from US. So technology is huge, and US has a large share. Now, within that, if someone wants to invest, this is a fund which Edelweiss US Tech Fund, which in turns invest in JP Morgan US Tech Fund, essentially, as I mentioned, captures these trends, and it invests into technology companies. Currently, if you see over the last couple of months, we have been talking about generative AI. In fact, the number of people adapting the open AI system when it was launched, within a matter of a month, more than 1 billion people signed up. In fact, just 5 days. So the adoption rate for AI is very, very high. Similarly, adoption for many other technologies, be it cloud computing, is very, very high. When we talk about these kind of businesses, it all boils down to technology companies. So there are companies which are into hardware, which are into semiconductor, which are into internet businesses, cloud computing, which will all take these themes and generate returns for the investors. This fund essentially identifies these kind of businesses which are into mega trends, where the adoption by consumers of these technology is growing, and there is huge potential for such adoption, and it invests into these kind of companies. If you see over the last couple of years, technology has one of the highest share in terms of earnings in the US market. The share of earnings by technology company is more than 50% in the overall US market. And even if you see in the overall world, the share of technology in terms of returns and earnings is very, very high. So this fund actually helps investors to capture that space and ride this theme over the next couple of years and decades to go.
All right, Niranjan, now looking at this particular space, okay, this is a sector-oriented fund. Even though you have international tech companies in it, an Indian investor who might be having exposure to tech already, maybe through large cap or mid cap, or maybe through a tech fund also. That kind of investor who's already invested in technology sector in India, do you think for diversification, such a thematic fund makes sense to their portfolio?
Sure. So there are two things to it. One is the technology that we talk about in India is very different when we talk about technology in US. In India, the technology is largely IT services, be it product services or software services. And when we talk about technology in US, it is more to do with semiconductors, hardware, internet companies, also technology not only in software or internet, but also technology in medical space like biotechnology. It also includes companies like Tesla, for example, which is part of the portfolio and not a recommendation, which is changing the way we drive cars, the way we all travel. So technology is a very, very broad theme. While in India, when we talk about technology, it is only confined to software or IT companies. But when we talk about US tech, it's very, very diversified. You will have technology-led companies from entertainment, from automobiles, from technology, which is IT sector, and healthcare and biotechnology. And hence, this diversification is quite different. And even if someone is invested in IT sector in India, this exposure is warranted because it adds a very different flavor to your portfolio.
All right. Last question on this fund, and we will wrap up the discussion. What is the tax treatment that an investor should know about?
Right. So, there has been a recent change in taxation as far as fund of funds are concerned. We all remember, there was a change in taxation for debt funds in India. So the taxation as of now is marginal tax rate for whatever gains you make in this fund, which is an FOF. The taxation will be as per your marginal tax rate. However, I think so, there are expectations that the taxation will be made in line with, the other equity, which is giving you indexation benefit when you invest overseas in India, overseas from India into maybe US stock, any other international stock. But as of now, the taxation is at the marginal rate. So one should be aware about this.
All right, Niranjan, thank you so much for being on the show and helping our viewers with all the nitty-gritties related to this particular fund. Thank you.
Thank you. Thank you.
All right, we move on. So that was the fund in focus, but then let's talk about loan borrowers. Now, loan borrowers are all for lesser home loan interest, but this rate has just got extended. But that being said, loan borrowers are also concerned and confused about the benchmark rates with which their loan is actually attached. Now, we're talking about external benchmark lending rate and marginal cost of fund based lending rate. And to understand the difference between the two and how would each benchmark loan borrower benefit, I have with me AR Hemant, Head of Communications, Bank Bazaar. Hemant, good evening and welcome to the show. A very basic discussion that we are seeing that's happening a lot on social media, also the difference between MCLR and EBLR. So just to give a basic understanding, what exactly is the external benchmark lending rate?
Good evening, Kavita. Thanks for having me here. So before I answer that question, just give me a moment to explain the concept of benchmark rates and spreads. So basically, your home loan agreement, it would have two things mentioned clearly. One is the benchmark rate and then the spread. The benchmark rate is the lowest rate at which that loan can be given, and no bank will lend below that rate. And the spread, which the banks can charge over and above the benchmark rate, is primarily decided by factors such as the borrower's income, credit score, size of the loan, and to a lesser extent by whether you're a man or a woman, where you work, and whether you're taking a new loan or refinancing an old loan. So to give you an example, the preferred benchmark rate today is the repo rate. The repo rate is at 6.5. And so we have one bank giving a home loan spread of 2 percentage points. So the final rate is repo plus spread, which is 6.5 plus 2, which is 8.5. So that's the lowest lending rates we are seeing in the markets right now. Now, what is the difference between MCLR and EBLR? Basically, these are MCLR is the old benchmark and EBLR is the now the prevalent benchmark in the market. MCLR is the RBI mandated benchmark between 2016 and 2019. And since October 2019, banks have moved on to EBLR. They had the option of picking the repo rate or the treasury bill yields. And the vast majority of them chose to benchmark their home loan rates to the repo rate. So that is where we are right now. Now, the key differences between MCLR and EBLR would be that, there's a reason why the RBI has mandated these changes over the years from MCLR to EBLR now, and before MCLR, there was also base rate and BPLR. And the constant refrain that RBI had was that, the policy rates are not being transmitted to borrowers, and that keeps the interest rates higher than they need to be. So that is why we have transitioned from one benchmark to another, and finally we are at EBLR. And the benefit of EBLR today is that, whenever the repo rate changes, within a span of 3 months, your interest rate, your home loan interest rate will reset automatically, whether it's falling or rising. it works both ways. Whereas what we have seen with the older benchmarks is that rates may rise rapidly along with rising inflation or the rising repo rate, but they tend to fall much slower than those things. Whereas with EBLR, it cuts both ways. It will rise rapidly, it will fall rapidly. So that is where we are right now. And most of the market right now.
Right. So this is one thing that I think we should be focusing on as to why the old rates would go down slowly as compared to external benchmark lending rates. So what's the calculation and what's the maths there, Hemant?
So MCLR is an internal benchmark rate, which is decided by the banks basis the cost of their funds. So if the cost of the funds are rising, they will pass on the cost of the funds to the borrower, right? That is why interest rates will go up regardless of the repo rate going up or down. And with repo rate, it's an external benchmark. It is controlled by the RBI. So your loan, if it is linked to the repo rate, it will change only when the repo rate is changing. So that is the key difference. And the RBI has also mandated that these rate changes need to happen at least once a quarter. So there is a lot of predictability in terms of what is going to happen to your rate. So earlier you were not clear by how much your rate was going to change and when. With MCLR, the when part of the problem was solved, because then you know that your rate is going to adjust once in 6 months or once in 12 months. With EBLR, the how much part of the problem has also been solved. You know how much your rate is going to change and when. And that is what has changed over the last 4 years.
All right. So can we say that most of these banks and most of these home loans are now attached with EBLR?
According to the RBI, almost 50% of outstanding floating rate loans were linked to the EBLR. About 45% were linked to the MCLR. Now, there's one interesting trend going on here, which is that with private banks, almost 73% loans are on EBLR. With foreign banks, it's at 84%. But with government banks, it's still only 36%, and that's dragging down the industry average to about 40, 49, 50%. So a lot needs to change with the outstanding government bank loans. I think there was a phase where people were reluctant to move on from MCLR to EBLR because they probably had very high reset periods, maybe 12 months, and they got through that period of 12 months, the last 12 months, without any significant rate hikes. So they would have thought that, okay, MCLR is better in this situation because my rate will not change for another year. But now as interest rates seem to be peaking, they'll be stuck with these high rates for another 12 months. So, it cuts both ways with MCLR as well.
So, Hemant, now for all the loan borrowers who have their loans attached with MCLR, do you think going ahead, whenever the times come for the resetting of their loan, it makes sense to approach the bank and ask for an external benchmark lending rate?
Yeah, I think you should. The first question you need to ask is how much you're paying over and above prevalent market rates. So to the ideal borrower with a good credit score, with stable income, the lowest rate that they can get right now is 8.4, 8.5, right? If you have a credit score of 800, you have stable income. And if you're paying, let's say 9.5%, you should question that, right? You're paying well above the market rate, well above what you should be paying. So you should 100% consider a refinance of some kind. There are only two questions to ask from that point, which is that should you stay on with your lender or move to another lender? If you are with a bank, you can easily refinance from an MCLR loan or a base rate loan to a repo linked loan. It's normally, it involves paying a small processing fee and minimal paperwork. If you are thinking of transferring your balance to another lender, it will require a little more paperwork, slightly higher costs as well. But if the difference is 50 basis points or 100 basis points, you'll easily recover that in a very short span of time. And once the rates start to fall and those rate cuts will be passed on to you immediately, you will recover whatever cost you had put into that refinance. Kavita.
All right. I think, Hemant, that will be all for today. Thank you so much for being on the show and helping our viewers with basic difference between MCLR and EBLR. Thank you so much. We move on and we'll take a quick break. Post that, let's get your queries answered by Feroz Aziz. And also, how can you have a zero debt portfolio and what would be the investment strategies for senior citizens on World Senior Citizen Day? All of this and more after this break with Feroz Aziz. Welcome back. You're watching The Money Show with me, Kavita Thapliyal. And let's move on. We have Feroz Aziz, Deputy CEO, Anand Rathi Private Wealth Management, with us to talk on a lot of topics related to financial planning and personal finance. So, Feroz, welcome to the show. And to start off with first, we are celebrating World Senior Citizens Day today on The Money Show. And let's begin with that. We'll be talking about investment strategies for senior citizens. Now, this is the kind of age where you obviously need to figure out how will you spend the rest of your life, especially if you are someone who doesn't have like regular income going on in this age of retirement. Definitely, Feroz, we cannot have a strategy that fits everyone. One size fit all will not be the case over here, as it is any which ways, you know, when you talk about financial planning, because it's always case specific. But there are some basic rules or maybe some standardized approach that one can take, you know, depending on the kind of risk factor or the kind of financial situation they are into. So what will be your first pro tip?
Kavita, firstly, like you rightly said, one size doesn't fit all. That's why it's called personal finance. And it's something personal finance is ingrained in our day-to-day lives. We need to acknowledge its presence every single moment because there is financial decisions you're taking. Even on a weekend, when you're going to be spending money on a movie theater, you are actually making an expense. So it's an integral part. And there's no one size fits all. So I concur with what you just said. Point two, there's a good news and a bad news. For all of us, because the longevity of a person or human being's life expectancy is increasing, which is a great news. But financially, that means you need to live a lot more after retirement. When we got independence, if I've read the numbers right, which seems so startling, Indian male age of mortality was 37 years. Today, we are somewhere around 68, 70 years, and Japan is at about 85, 87 years. So point I'm trying to make is post-retirement, the number of years you will have to live on your retiral corpus is going to be a long period. It's not like 5 years anymore. It's 20 years you have to live out of your retiral corpus. So that's the second point I'm making. Now, the strategy emanating from the second point is that if you have 10, 15 years, 20 years of investing post-retirement, equity can't be ignored even post-retirement. Otherwise, 10 years back, 15 years back, people said, now I'm retired, so equity becomes zero. So now a retired person in the current contemporary situation will have to have equity as a part of his portfolio. So the pro tip is to have equity. It's the proportions which can be different for each of us at retirement, but it can't be zero anymore.
Right. But Feroz, let's also discuss a bit on the withdrawal strategy that you might want to adopt, you know, on the kind of investments you've done all your life. So how can one implement that? I mean, again, we cannot have like one strategy, like a go-to strategy for everyone. But then how should we implement the process of withdrawal?
Kavita, see, if somebody is retiring now, he needs to or she needs to divide their money into three components. One is short-term current consumption of the person as per the expense. Second part is the long-term consumption amount. Third is intergenerational. Some of us could be fortunate that they have money which they have to pass on to their children and grandchildren. If that's not the case, the bucket one and bucket two need to be distinctly, correctly defined. If somebody's got a crore of a retireable corpus, let's assume that if there is an amount of 50,000 rupees needed every month, then there is 6 lakhs to be put in a 1-year instrument so that you can consume the 50,000 each 12 months. And then the rest of the 94 lakhs can be beyond 1 year. So you divide it as 1 year consumption, short-term consumption, 5-year consumption, and then it could be long-term consumption and even intergenerational. So that's the second point I'm making. The third point I like to make when it comes to withdrawal, always like to look at put so much money that you withdraw only 6% of it. So 1 crore rupees can give you a withdrawal of 50,000 rupees per month. You may put 6 lakhs in a short-term instrument, but if you're consuming more than 50,000 rupees a month in a 1 year, 1 crore corpus, that means you're eating into your corpus, which is not advisable. Hence, point one is 6% kind of withdrawals are possible. And SWP is a great method to withdraw money, which is far more tax efficient during retired periods.
One last question, Feroz, and then we move on to our viewer queries. Gone are the days when senior citizens, were prohibited from investing in equity. Even at this age, if you think you have a portfolio that's diversified well enough, a certain amount of exposure can be taken and, in fact, should be taken in equities.
Yes, Kavita, see, the perception that equity is riskier than debt can also be questioned. Okay, debt is safer because it is perceived to be safer because it does not move in price every day. But I have seen several people who have lost their entire money in debt, but I have not met one person who has lost his entire money in equity. Equity sometimes is safer than debt, not on a daily basis, because a bond can go default, right? There have been some cooperative banks which have defaulted on their FDs, and monies have not come yet in spite of having finished 12 years. And I'm speaking about one specific example. So there, if people thought debt was safe and they lost all the money, equity is considered more riskier, but you can in 12 years never lose money. So that's point one. Point two, what should be the proportions? Let me give some numbers to it. If you have long-term monies which are greater than 10 years, then at least have 30% in equity, 70% in debt. Your average return, looking at the contemporary situation, could hover around 9 to 10%. If it's medium-term goal, then have 20% in equity, 80 in debt. The average return could be 8.5%, and short-term goals put 100% of the money in debt. Short-term, by which I imply 3 years. Have a return expectation of not more than 7.25%. And when it comes to the schemes which a senior citizen can look at, to be more specific in terms of advice, IDFC Guild 2027 Index Fund, which is a pure Government of India paper, could be a good fund to consider. Aditya Birla Sun Life Nifty SDL April 2027 could be another fund for debt. On the equity side, Canara Robeco FlexiCap, DSP Equity Opportunities, HDFC FlexiCap, Kotak Emerging, and SBI Contra could be the 5 funds which, as per the proportions I just described, could form a part of the equity portfolio.
All right, Feroz. Quickly, let's move on to our viewer queries now. We will be taking Devendra Sali's question. Feroz, I think you have the fund details. There are almost 9 funds in his portfolio, and he says that he's investing 9,500 every month. He wants you to check his fund mix, and also he plans to invest for more 15 to 20 years. So how is the fund mix looking to you?
Yes, there are about 4 funds I would say can just stay put. In fact, 3 funds which he can exit: Mirae Asset Hybrid Equity Fund, Navi Nifty 50 Index Fund, ICICI Pru Small Cap Fund. These are the 3 funds you can consider to exit. There's a rationale for each of them. I personally think if you're investing 10,000 rupees, you don't need a hybrid fund. You need a debt and equity separate. I don't like index funds because beating a Nifty index by the choice of the right combination of funds is a reasonably high probability event. Out of the 384 active managed funds, you can surely get a combination to beat Nifty. Now, ICICI Pru Small Cap Fund, there are other 3 small cap funds which I personally like from a futuristic standpoint. So the funds you can consider to invest in is Franklin Blue Chip, HDFC Small Cap, Quant Active, ICICI Focused Equity, SBI Contra, and Kotak Emerging.
All right, so that's the solution for Devendra. But then, Feroz, I think you've got some tips for our viewers to make a zero debt portfolio.
Yes, see, Kavita, this of course is a very radical thought, comes as a little intimidating concept. But I personally think that if you look at the last several years of history, with our Indian capital market has been in existence for a reasonable period. So we did a lot of study. 1 year rolling return, 2, 3 year, 5 year, 6 year, 10 year rolling returns, and even 15-year rolling returns on Nifty. Which means that if you invested every single day the market opened and removed the money after 1 year, 77% of the times the return was positive. If you invested every single day and redeemed 3 years hence, the 96% of the times you made a positive return. If you did that same thing for 5 years, 99%, 6 years plus, you were always in the positive zone on Nifty in this century. And that's how many number of days? 6,026 days, which is the full centuries, all working days considered. So 100% probability to beat capital and always be in the positive territory. So anybody who has more than 6 years should not consider equity to be as risky as they perceive to be. In 10-year period, if you bought it every day, sold it exactly after 10 years, even the unluckiest 10-year investor has not lost capital for this century of 2000s. Okay, and so similarly, there are for 6%, there are the probabilities for 6% plus, which is the opportunity cost of debt returns, are also very healthy. And on a 6-year basis, 90% chance that you will beat the FD return or the debt return of 6% by investing in equity. So please don't be shying away of even having a 100% equity portfolio at ages of 20, 30, 25, 30 years of age.
Fantastic. I have more questions on this concept and this research that you've done, but then we have our viewer online with us actually, Mr. Krishna. Good evening. How are you doing and where are you calling from, Krishna?
Hey,
Hi. Can you hear me?
We are doing good. We are doing good. And
Great.
I am calling from Narsipatnam. So
all right. Okay, so Krishna, I think we've got your query. Is there anything else you want to add to the question? We have all the details. So can I just proceed? Can I just go to Feroz for a check on your portfolio?
Yes.
All right, thank you. Feroz. Yes, I think Krishna, see, if you're looking at a 3 crore kind of a corpus in 5 years, the SIP amount needed on a monthly basis would be 50,000 rupees. And at an expected rate of 14%, you will get to a corpus of 3 crores. Secondly, when it comes to your scheme choices, I would say Mira Asset Tax Saver could be considered for an exit, Canara Robeco Small Cap, Axis Nifty 100 Index Fund, Parak Flexi Cap. These are the 4 funds you can consider to exit. And there are several funds you can look at investing: Quant Tax Saver, Quant Active, SBI Contra, DSP Equity Opportunities, HDFC Small Cap, ICICI Focused Equity, Quant Active, and ICICI Dividend Yield. So these are several funds given to you from a perspective of you can consider for the replacement of the 4 schemes which I said. Now, at the age of 37, like we were discussing, Kavita, on the previous topic of can a person of that age have a largely or 100% debt equity portfolio? To my mind, yes, as long as they are mentally prepared to see ups and downs. Equity will beat debt in a country like ours on a 10-year basis. It is practically an impossibility on a growing economy that debt is outbeating equity. You just have to weather the volatility in the short term to be able to realize the benefit of an extra return over debt. So at your age, Krishna, I think I would not waste 30% of my money in debt. I would consider myself fortunate to be living in India in these years of Indian economy.
Which is why we say that you need to plan your finances, get a financial planner for yourself and just align all your goals as per your investment instruments. Before that, do the right kind of homework that you get to learn from our show. Thank you so much, Feroz, for being on the show and helping our viewers with all of this today. Thank you. All right, on that note, it's a wrap on The Money Show, but I'm going to leave you with our WhatsApp number and our email ID where we keep waiting for your queries so that we can do your life financial planning with our experts. Thank you so much for watching. Goodbye.